$65 trillion. That's the amount that's projected to be flooded into the private markets by 2032.
Today, I'm joined by a fantastic guest. His name is Seth Bradley.
Seth on here, SEC attorney, doing a bunch of things. Excited to have him on here, a wealth of knowledge.
I want to introduce you all to Mr. Seth Bradley. Mr. Seth, how you doing today, sir?
Seth is with a portfolio of firms that he runs. One of the main firms he focuses on is Raise Law.
We've done 750 funds and syndications. We've done $9 billion in transactions, representing $3 billion in capital raised for my clients, partners, and for myself. I grew up in West Virginia. My dad's a retired coal miner. My mom's a retired grade school teacher. So I wasn't really exposed to entrepreneurship or owning real estate or anything like that. You know, obviously there's a difference between personal and business, but the closer you can make those two things the same, the more you're gonna feel kind of centered in life and the more fulfilled you're gonna be. Entrepreneurs, we're always on the forefront of that, and we just need to be ready and see those opportunities and take advantage of them. I wanted to put my baby girl up there. She's 7 months old, so I'm a new dad and really loving it, and she's fucking adorable. I mean, look at that. Just always remember your why, right? Like, always remember why you're doing it. It's not just to get rich, not to get wealthy. All right, folks, eat, sleep, raise, repeat. This is go time. So let's fucking go. So here's the question though. Should I do a fund or a syndication? It seems simple, it seems easy, but literally all these calls that I get on with you folks, like everybody's like, man, which one should I do? Which one should I do? Even though you might have multiple deals, should I do a bunch of syndications? Should I do a fund? And analysis paralysis is killing your raise because you just need to launch, need to get going. So the first question you really need to ask though is, can you get paid for bringing people into deals? Because the general rule is you're not allowed to raise capital without a license. Just like I can't practice law without a license, you can't be a doctor, you can't practice medicine without a license. Same thing goes for raising capital. You have to have a license, you have to be a broker-dealer, you have to be an RIA, unless you find an exemption. So we live in the exemption world. We need to find an exemption. Most of the time, it's because you're a GP, you're a lead sponsor, you're an owner, operator, you actively run the deal. So you earn your capital, you earn your fees through the deal. You're the lead sponsor, you're the operator. Sometimes you'll hear this as the issuer exemption. It's your deal. Most of the people in this room probably sit there, but other people might be an aggregator, so a capital partner. You bring the capital into the deals. Many of you also sit here, or if you're a lead sponsor, you really want these people raising capital for you, for your deals. And then you've got to figure out how to bring them in compliantly, right? And we'll talk about that as well. And this is the one with the most traps and the one with the most gray areas that I mentioned earlier. So I'm going to give you the structured decision engine. 3 gates, 3 questions. You should be able to answer these 3 questions pretty easily when we walk through them. And you can decide if you're going to do a fund or a syndication, or if you're an aggregator, it gets a little bit more complex, like what kind of fund-to-fund you're going to do, that sort of thing. But gate number 1, is it even a security? You have to decide, is it a security? Do I need a fund or a syndication at all? Maybe I don't. Maybe I structured it a different way, and I don't even need a fund or a syndication. But let's say you do. Or it is a security. So then you got to ask, are you the operator or aggregator? That's pretty easy. You guys know what you do. Are you the lead sponsor? Are you the operator? Or are you a capital partner? And last, one deal or many. And then we can do a little subset thing here after that. So here's the whole toolbox, the ways to structure a raise. So, and sometimes you'll see syndication, you'll see fund, but there's some others up here as well that I know you've used before, right? So fund to funds as well, that one gets a little bit more complex. We'll talk about why. But you've also got the joint venture. A lot of folks out there use the joint venture, or they call it a joint venture, and it's not even a joint venture. And we'll talk about that too. And then a note of deed of trust. I know there's a lot of developers out here, folks that are doing luxury, single family, so maybe you borrow for each single one, you get one investor lender, so you get a note, you get a deed of trust, kind of a traditional structure. Well, the funny thing about that is, it's actually a debt is actually presumed to be a security. You have to show that it's not a security. So gate number one, is it even a security? This is the legal framework, the Howey Test. So you want to sound smart in front of people, you call it the Howey, you're like, all right, are we doing a fund of syndication? Are we doing a JV? Talk about the Howey Test. This is what lawyers look at. That's the case. 4 prongs, an investment of money in a common enterprise with an expectation of profit from the efforts of others. So investment of money, easy, right? You're going to take money from somebody, whether it's debt, whether it's equity. You're taking investment of money, that's easy. In a common enterprise, maybe that's through an agreement, maybe that's through an entity, an LLC, or a limited partnership. Pretty easy as well. With an expectation of profit, did that person give you money and expect a return on that capital? Pretty easy there too. The 4th one is really the one you really need to analyze. So from the efforts of others, profit comes from somebody else's work. They gave you money and you're doing all the work, not them. They're not doing anything. If they are passive, if they expect you to do all the work, the efforts of others, then we've got a security. So there it is, the JV trap. You call it a joint venture, you bring in a partner, right? In a real joint venture, everyone has real authority. You can't just bring somebody in, they give you money, and then you don't give them any rights. You say, oh, I'm going to do everything, don't worry about it, right? They have to have hands on the wheel. They have to have decision-making processes. They have to have management, at least over major decisions. They have to have access over financials. And they have to have the ability to remove you as a manager. Profit from their own efforts. That's the key there. They're actually participating in the deal. Maybe they're not the one swinging the hammer. Maybe they're not the one managing the asset. They're not the one signing the loan necessarily, but they do something, their own efforts. So voting, managerial rights, their efforts. Howey prong number 4 fails, not a security. The disguised security is just that, right? One partner brings only money, passive partner that has no control whatsoever. They just give you money and expect a return on their capital, and they rely on you and you only to produce a return on that capital. Promissory note, deed of trust, we talked about that, and it's interesting because a lot of you folks are developers and you've done this before. You've used a note and a deed of trust to borrow funds from your investors. It is presumed a security. You have to show that it's not a security. I think people are surprised by that. One lender, one loan, secured by real estate, probably fine, right? Probably fine. But when it starts looking like a security, meaning let's say you bring more than one investor into that note, you bring 2, 3, 4 people, fractionalized. Maybe you do this over and over and over. Maybe you have a pitch deck for it. Maybe you put it out there into the public and you say, looking for a lender for this deal. Bring in a couple for each one. It starts looking a lot more like a security, and it probably does. This is one of those kind of gray areas. We use what's called the family resemblance test to figure that out. But the more that it looks like a security, the more that it looks like an investment, the more that it doesn't look like just a lender that's in the business of lending money, the more it looks like a security. Gate number 2, are you an operator and aggregator? This one's pretty easy. If you're the operator, you find, fund, and run the deal. You raise capital, you sign the loan, you execute the business plan, you develop, you asset manage. You know this, you're doing this. You get paid through the deal, through fees, promote. Real non-capital raising activity. Yes, you can raise capital for your own deal that you're an active partner in, but there have to be non-capital raising activities that you're completing. The aggregator, maybe not. They're the capital partner. They're not in the operations. Yeah, maybe they signed as a member of your LLC, but are they actually doing anything other than raising capital? Lots of times they're not. But the good news is there are compliant paths that exist, but the bad news is people have abused this pathway time and time again, especially over the last 8 years or so. So getting paid to raise the compliant paths, you've got a fund of funds, an SPV. Those have been really hot over the last couple of years. A genuine co-GP or a joint venture, or even a finder. And we'll talk about finder because a lot of folks will use that as well. Really difficult to navigate that exemption. It's not really an exemption. It's an SEC no action letter that birthed that, and it's really difficult to do. You won't find a securities attorney that'll tell you to try to do that. The trap, the code GP and name only, if all you do is raise capital and take a cut, and especially if your compensation is based on how much you raise, so you didn't agree up front, you said, all right, well, I'll give you 5% of the GP. You offer this to one of your capital partners. You say, I'll give you 5% of the GP. And you anticipate that they're going to raise $500,000 for you. But come to find out, they're not very good at capital raising. They raise $100,000 instead of 5. You say, I'm not giving you 5% now. I'm going to give you 1% because you raised 20% of that. That's transaction-based compensation. That is illegal. We say non-compliant. Sometimes it sounds a little bit softer. But it's actually, it's illegal. You can't do that. You cannot do that. And because they're part of your company, you're in trouble. Not just them. You're in trouble because you brought them in as a member to your company. So gate number 3, one deal or many, syndications versus fund. You guys know this. Even though you have multiple deals, you can put them all in one. You can put them in a fund. So pooled capital across multiple assets. There's many different kinds of funds, blind pool, semi-blind, seed deals. You seed the deals, you seed your fund with a deal or two. That would mean semi-blind because the investors are semi-blind to what they're investing in. They see some of it, not all of it. Raise once, deploy repeatedly. Investors bet on you. So you need more trust. So that's the key there. It's harder to raise for a fund. So that's the thing. A lot of folks will kind of jump into this really quickly. They're like, really excited. Let's raise a bunch of capital. Let's start a fund. I just want to have, a few $million in the bank so that I can pick and choose where to invest. I've got lots of deals. It's hard to raise for a fund if you haven't raised before. Now, if you've got experience, sure. But just know if you haven't done it, it's hard to raise for a fund because you have to get that investor trust. They have to give you money before you have a deal. And then you take that money and invest it in something. So they have to take your word for it, that it's going to be something they want to be part of. Compared to a syndication, it's a GP that finds funds and runs one asset. LPs bring the passive capital, but they don't have any control. One entity, one asset. It's a security. We talked about that. You have to find an exemption, 506B versus 506C. But another advantage that we don't talk about is asset protection. In a syndication. It's high. It's a siloed security. It's very similar to if you buy houses one at a time and you put an LLC, or you put a house in each LLC instead of putting a bunch of houses in one LLC. Kind of the same concept. Same concept here. And the ease of the raise, it's easier. The investor can underwrite the deal. They can look at the property. They know exactly what they're investing into. But again, the trade-off is flexibility, right? As a capital raiser, you strive to probably end up in a fund. You want to have a fund where you have all this capital ready to go. You can make really powerful, strong, confident offers because you know the capital is ready to be deployed. You don't have to worry about getting it under contract and then raising. You've already got the capital ready to go.